Good morning, everybody. Welcome to Amati, another Amati Insight call. Just before we start, as always, I'm going to share my screen with some of our disclaimer information. Just bear with me for a moment. So hopefully you see it on the screen. As always, we're going to mention stocks and funds, and none of this constitutes recommendation to buy any of those. This disclaimer is also on our website. But just a reminder that we do this every 2 weeks on Tuesday in the morning, not to interfere with your day. We hopefully keep it to 10 minutes us talking and 5 minutes Q&A or thereabouts. And the subjects we pick are topical investment debates, things that market cares about, our clients care about, and where we have a considered research-based view. And the subject today is, dare I say it, an EV price war. Some changes in Tesla pricing that's really taken market aback, and some implications and thoughts about that. So I'll pass it on to Graham to give us a bit of a background and introduction.
Great, thanks, Miguel. Yeah, so we think it's a really interesting time to be looking at the EV market because of some of the things that are going on in pricing. So Tesla, as Miguel mentioned, they've been cutting prices now quite materially since the beginning of the year, in fact, slightly before that. So they've cut about 20% on average from their two main models. And part of that is unwinding price increases that happened over the past couple of years, obviously due to shortages in the market. But we think that's only part of the story, really. Elon Musk is trying to drive sales growth as he is starting to ramp production of his vehicles. He has 2 sites where he's really ramping up, one in Germany and one in Austin, Texas. And he's looking to double the production that he achieved in 2022 in the current year, so getting to 2 million vehicles, which is obviously a very significant increase. And he's doing that in an environment where demand is softening somewhat for a number of reasons that we'll touch on, but particularly we think because of the significant increase in competition we're seeing from other players now in the EV market. So Tesla, they're not alone in cutting prices. We heard Ford's CEO saying that they're seeing price wars breaking out everywhere. And the fact that inflation means that consumers are feeling the squeeze at the moment really is pushing the OEMs to try and lower prices to sort of get to as the GM CEO said, sort of meet the customer where they're at on affordability. And for context, what are we talking about in terms of pricing? Well, the Model 3 and the Model Y, which are Tesla's 2 main models, they're selling for about 42 and 45,000 euros respectively. And that compares with the VW ID3 or ID4, which is about 40,000, and Hyundai Ioniq, which is a sort of comparable vehicle for about 44,000. So Tesla's really hitting the competition head on in terms of price, we think.
Yeah. So why is this happening? I mean, what are the underlying reasons for that? Is the current market debate, especially following the recent results, where we've seen a bit of a margin correction and obviously negative price reaction for Tesla. So we think there are 3 main possible narratives that market is, and then the company are kind of addressing. One is a bit less flattering, and that's frankly, like Graham said, it's an increased competition. So you have to do this. You had the market to yourself, especially the higher end, and you no longer do. And there's also aging model cycle. I mean, Model 3 and Model Y have been with us for a while, and they're probably not as new in consumers' minds. The second, which is a bit more, I feel like, generous and to the company, is this is a classic Silicon Valley tech playbook. Create a scale and cost advantage and press it. Increase the volumes, temporarily suppress profitability for yourself and the industry, but come out on top with the superior scale over time. And the third one, and that's the one the company and Elon Musk himself had mentioned on a number of occasions, is this isn't about selling cars. This isn't about making margin on cars. It's about building this installed base and then coming up with a software model, a services model that kind of, in a sort of razor blade type way, makes money off your installed base. That's we think the version 2 and version 1, the competitive pressure and the Silicon Valley kind of pressed scale advantage are the main reasons today. But no doubt, strategically, the company is thinking, we can eventually make money somehow on this installed base. And there is a risk that they might substantially depress their end competitors' profitability for a while they're making this play out. Now, they do have really good margins. They, for a very brief period of time, for about a year and a half or so, they had the best margins in the industry. I remember Tesla wasn't profitable for 10 years, but then became profitable for the last 3, and was quite profitable for a couple of years. But the cash flow is something to watch. The company, for the first time in several years, was cash flow negative in its auto business. Its overall cash flow was positive, but that's because they sell this so-called regulatory credits, kind of things they sell to other car makers who don't produce enough EVs to satisfy various regulatory requirements. This is not a good measure of the underlying auto profitability and cash generation. And for the first time in a while, that turned into a cash consumption. And in fact, we've seen an increase in inventories, which is always a worry for an automaker. Now, these are important questions for Tesla stock, but they're raising pretty important questions about the broader business model for the whole EV industry. So, Graham, what are those? What are we most interested in?
Yeah. I think one of the key ones is really about the kind of the model life cycle. So how do we think about, how is EV changing the way we think about cars? Tesla runs a very concentrated model list. They have, as I mentioned earlier, sort of 2 major models, the Model 3 and the Model Y. They do have 2 others, in fact, shortly to be 3 others, but those are quite limited production runs. So, the 2 main models, you get the choice of very limited choice of different trims. It's not quite as bad as Ford's Model T. You have any color as long as it's black, but it's that's definitely a bit of his approach. Where you compare that to some of the sort of traditional OEMs, even Skoda, for example, is talking about building 6 new EVs over the next 3 years. So, the traditional model of OEMs is being questioned here. And Tesla, if you look at Tesla vehicles, they don't change much in terms of physical appearance over time. Really, the way they approach it is to give you more frequent software updates. The idea being that new software makes it feel like you have a new car or a change to your car. And we feel that model was working well when Tesla was really the only player in the market. But in a more competitive environment, that's definitely under question. And it also leads to a broader question around the business model. Traditionally, OEMs would make up to about 20% of their earnings from spares and repairs. And that's not the case with EVs to the same extent at all. There's no oil filters and spark plugs and clutch plates, and there are many fewer moving parts in an EV. So it's really about how do we think about the relationship we have with the vehicle as we go to autonomous driving. That changes things again. So there's a whole list of questions here that we need to think about, we think.
Yeah, I mean, one question we don't think about much anymore is we think electrification is here to stay. And there was a bit of a debate last year when electricity prices gone up, and people were wondering, when the subsidies phase out, now that it's not so obviously cheaper to so-called fuel, if you like, electric vehicle compared to the traditional internal combustion one, will we have enough specialist metals to reach the targets? It's interesting to observe for us. I mean, we just met two of the world's largest so-called tier 1 suppliers, one of those multi-product auto suppliers, over the past couple of weeks, and both are completely betting the farm, pivoting their whole business towards electrification. So the industry believes the future is electric, no questions asked. But for this to happen, of course, the EVs need to become truly mass market. I mean, the Tesla ASP for the last couple of years, as Graham mentioned, was kind of high 40s, $50,000. These are not mass market products. You need $20,000, $25,000 euro pound car to really catalyze this mass market demand and mass market scale. And you're starting to see announcements to that effect. Volkswagen ID.2 is aimed at being below 25,000 euros, but it's only due to 2025. You're seeing some specialist products, Dacia Spring, which is a Renault company, kind of a cheaper Renault brand. They have a product which is sub 20K, but the trim isn't great and the range isn't great at all. But the one thing we've noticed in the Chinese market, for example, there is a place for shorter range, lower trim kind of city vehicle, and some customers find that enough for their commuting needs. But I think the broader question of China is really quite striking. Graham, we've seen some amazing statistics coming out of the market over the past year or so with regards to electric vehicles.
Yeah, it really feels like the kind of the center point for the market has shifted to China now. China is a very significant market in size. It's actually about 2 times the US in terms of volume of vehicles, which gives the manufacturers there quite a significant home advantage. And as a result, they've developed some very large local players, notably one BYD that many of you will have heard of, Build Your Dreams, it stands for. They've grown so significantly in the last few years that they're now, as at this year, on run rate terms, outselling Tesla in EVs. And in fact, in March, they grew 97% year over year, so growing incredibly fast. And they're really, so they have this very large local domestic market, and they're very focused on price. So they've just launched a new vehicle called the Seagull, which really does hit that mass market appeal, with a price coming in just below £8,000. So, you know, they're very focused on getting volume out. And this is the environment that Tesla increasingly is going to have to face. And the Chinese it's not just in their domestic market, they're starting to go global. Some countries, Chinese EV penetration is already quite high. If you look at Norway, for example, the number of Chinese vehicles is already on a par with Volvo, for example. So very dynamic market, very focused on price. And we think that has significant implications for the OEMs in other countries.
So where does that leave us as investors? So we don't own Tesla. It's obviously been a brilliant business run by a brilliant entrepreneur, but it is entering a very challenging period in its history. One of the more challenging ones. It's now seeing negative cash flow in its auto business. The margins, I mean, they lost 10 percentage points of margin over the last year as part of this price concessions. So this, and there's still effectively, I mean, 2 models, but it's effectively one model. Model Y and Model 3 are very, very similar under the skin, and the model refresh outlook isn't clear. So it feels like for half a trillion market cap company, much more than 40 times price earnings ratio, there's quite a lot of risk that we don't feel is in the price. So we're staying on the sidelines for that one. It obviously raises broader industry concerns for other OEMs. If we're entering this price war, you know, what does it mean for the incumbents that are pivoting into electric vehicles? We do on Volkswagen, where the sum of the parts valuation is such that if you exclude the value of the stake in Porsche, which is doing great as a business at the high end, you get Volkswagen and Skoda and Lamborghini and Bentley and Seat and all the other assets, Audi, of course, for free. So it's not risk-free, but a lot is in the price. A lot of that risk is in the price. But our confidence in the size of our position is tempered by this industry risk. But where we see most opportunities in what we call the enablers of electrification. And our biggest position in that space is Infineon, which is a power semiconductor supplier. Now, as you move from traditional powertrain to electric, the content of this very specialist chips that manage this high voltages, high power currents in electric vehicle go up to 5-fold. So you really are quite well insulated from the auto cycle if you win so much content. We also own relatively a little known Taiwanese company called Yageo, which makes capacitors and other passive components that again really benefit from this electrification in autos as well as other end markets that they serve. And we own a connector and cable a company called Amphenol. Again, obviously, if there's a lot more electricity to ship around the car, there's a lot more cables and connectors to employ. So it's a content growth story rather than a link to pricing or unit growth in the industry. So we're kind of taking a relatively risk-averse way into this innovation frontier. And that concludes our presentation for today. So we'll see if there's a Q&A button underneath your screen. I should have mentioned this in the beginning. So if you click that, you can type in your question, and we can see if we have any. And the one question we had was, probably I'll ask it. I'll direct it to you, Graham. Do you own any Chinese or any of these Chinese OEMs?
We don't actually. I mean, Mikhail just went through the companies we hold that are related, but the reason we don't hold any of the Chinese OEMs is not because we don't think they're interesting companies and high growth, but more because investing in China is a complicated and risky thing to do. We've seen on a number of occasions, there are several examples where there have been problems with the way the Chinese state deals with senior management if they're not doing what they want or not behaving the way they think they should be. Not to mention the fact that China breaches our own human rights rules around our ESGH process. So investing in China for us is complicated. We agree there are some interesting companies there, but we don't hold any at the moment, and it's unlikely we will in the short term.
Great. Well, I think that gets us up to 9 o'clock, so we're out of time. But if you have any follow-up questions, send us those via your Amati contact. And if you have something you are curious about, want to talk to us or with us about next in a couple of weeks' time, then let us know, and we'll try to cover that. Thank you very much for your time, and see you again in 2 weeks' time.